Hello and welcome to Rock Webinars. Today we're going to discuss the presentation Coronavirus Projected Impact in Real Estate, where I have developed a four variable model to try to see what's going on and where it is heading. I hope you enjoy. Let's go right into it. The program for today's presentation is first an introduction, the expected changes in social habits and behavior, and trying to decode uh, those or that impact into real estate impacts. Then we're going to make an estimated ranking of product and location impact into real estate assets and the relative impact in each of the different products. Then we're going to discuss a bit about the recovery path, V-shape, bathtubs, L's, U's, and W's, you name it. Then we're going to present the four factors, uh, the fear factor, economic recovery, market correction, and location correction. Then we're going to do some runs, some modeling simulations, first unweighted and then weighted for each factor. Finally, we will make a discussion and hopefully reach some useful conclusions. I think that by now it has become evident that until a vaccine is developed or we reach what in epidemiology is referred to as herd immunity, coronavirus and its impact in our daily life and activities will stay with us for a long time. The, the impact on the economy is already substantial, and entire industries such as oil and gas, hotels and restaurants, airlines and airplane manufacturers, educations, cars and car manufacturers are already being hit the hardest. Construction disruption in real estate development projects has also been significant, but because most countries consider it part of the essential services, it has not been hit as hard as others. And projects are just managing to keep moving forward, especially in the suburbs. Still, it would be naive at best and irresponsible at worst to think that the social and economic impacts of the coronavirus will not impact the broader real estate industry. This webinar is an intellectual attempt to give visibility to what is happening and how it will probably shape the future trends in the real estate markets and industry. Um, I suppose that as any attempt of predicting the future, I will be at least partly wrong, which in turn means that I will be partly right, and some of this information might become useful. Um, in the next section, I will present my views on the changing in habits and behavior that the COVID-19 will bring about in society and try to decode them into their impact in the real estate products of the future. First, it has become evident that social distancing is a must, um, and that means increased distance to co-workers, increased distance to neighbors, fewer trips to restaurants and shops. Also, enhanced hygiene standards, hand washing, sanitation stations, extensive use of face masks, latex gloves, etc. Also, remote work has become the thing on these days. And although it is mostly self-explanatory, it also means adequate working spaces at home, adequate teleconferencing hardware and software, better and more reliable internet speeds and connection, increased food and e-commerce deliveries, food products and packaging inocuity expectations or demand by the consumers, disinfection protocols, seals of warranty, etc. Also, there will be an increased awareness or concern of what we handle, who has handled it before us, and also establishing disinfection protocols. All these impact in our social habits and behavior can be decoded um, into the challenges that will bring to the real estate industry, the development of our uh, products will have to be revised, and probably new standards will have to be applied, and that is a challenge to all the real estate development chain: investors, developers, architects, engineers, general contractors, and certainly property managers. I have attempted to decode in the next slide the changes in habit and behavior and their impact in the real estate industry. So, social distancing means, besides the obvious impact on hotels, offices, and shopping malls, restaurants, bar gyms, and large venues like cinemas, theaters, stadiums, etc. The surviving offices, and I use this maybe a bit extreme term, but I think there will be a lot of, it will take a lot of time for the office market to recover. And presumably, they will need more generous space between co-workers. Single family homes will be preferred over condos or apartments because it implies a natural social distancing. So, although this will be a reality, it has also got to do with location. Uh, you won't find single family homes in inner cities, so the suburbs will probably benefit from it. Uh, it also has an economic factor. Single family homes tend to be more expensive than condos or apartments. Um, Also, presumably, we will need bigger pantries and kitchens. Um, the enhanced hygiene standard will mean probably hand washing and sanitization at building entrances, shoe covers, dispenser and disposals for delivery personnel, maybe even some uh, facilities at the entrance of the single unit to get rid of our own masks and shoe covers or whatever. Remote work, um, will this mean probably the return of the home office of the 80s and 90s, um, but this time with enhanced teleconference hardware and software. Also means package delivery with disinfection stations, entry lobby with vanity room for clothes, shoe changing, mask, glove disposal. Increased food and e-commerce deliveries probably again will mean that the entry lobby of the property will have to have some sort of vanity room for uh, cleaning and changing of clothes and shoes, etc. Um, Property managers will probably have to establish disinfection protocols and enforce them. Um, and disinfection home entry lobbies with shoe racks and mask, gloves, disposal stations. These are all ideas that meaning trying to decode the expected changes in social habits that we already have seen uh, with the real estate industry. In my opinion, the biggest will be disinfection stations, cleaning facilities at building entries and probably at premises entries, waste disposal, waste disposal for both residents, workers, and delivery personnel, uh, the return of the home office concept of the 90s, backbone high-speed internet throughout the premises, modular and ergonomic desk furniture for the small and medium-sized apartment. As I said before, this will probably bring about changes in design of the products, and certainly it is a challenge for architects and developers, and it will probably shape our real estate products of the future. Um, of course, these are opinions, and as such, are not necessarily backed by relevant data. Still, it is an intellectual exercise, and also we are already seeing some of this happening. In my opinion, the hotels, restaurants, bars, and other entertainment, retail, and office will be hit the hardest. Residential multifamily, then residential single family, specific use, and industrial should be hit the least. I also say that, or I also think that big urban centers, which I call cosmopolitan urbans, like New York, Los Angeles, Chicago, Houston, Miami, Atlanta, will be impacted the most, and suburban cities or towns will be impacted less. So I also developed this classification where cosmopolitan urban, of course, will be hit the hardest and suburban the least. And I assign an impact value for each of these. Hotels, 25%, restaurants, 20%, retail, 20%, office, 15%, residents, 10%, residential single family, 5%, specific use, 0, and industrial plus 5%. And also, uh, according to location, cosmopolitan urban minus 15, urban minus 10, and suburban 5% positive. So this means that people will prefer suburban locations for doing anything, basically from going to work, going to the office, going for shopping, restaurants, or even living there. So with these variables in mind, you can make this matrix that I present in this table, and cosmopolitan hotels, for example, will be hit at the 40% level, where office urban at 25, residential single family, suburban will be almost not hit at all, and, industrial will come on top. Remember that this is all in relative terms as to before the pandemia came about. So let's say uh, December last year. Um, well, here a word of caution. I never have believed in IRR reported with two decimal places, so I would presume that my numbers might be off 5% one way or the other, and I think this is good enough for the scope of this intellectual endeavor. In the next slide, I will present the results in graphic form, showing the data as balloon rather than dots, precisely because of my previous comment. So in relative terms, hotels and restaurants, retail, and office will be hit the hardest. Uh, Residential, multifamily, and single family less, and specific use in industrial even less. And some of them will even become on top, come on top after this pandemic. And I'm always insist that I'm referring relative terms before the crisis began. So now let's talk a bit about the expected recovery path. V-shaped is a classic shape of this recovery curves and or crisis curves. It has happened before, and there is literature about it. Some are already starting to see that this is going to be the way moving forward. Um, who knows? Then there is the U-shaped recession, also sometimes called bathtub. It's also well documented, and as I said, it has happened before. W-shaped recession, uh, again, this is a recession where we think we hit bottom, we recovered fast as a V shape, only to fall again and start all over. So it's a double a double B if you want, or a W. Now let's discuss a bit the four factors of my modeling. First is the fear factor. Uh, Fear is a powerful and primitive human emotion. It alerts us to the presence of danger. Fear can be divided into two stages: biochemical and emotional. The biochemical response is universal, while the emotional response is very individual. There is a Dr. Karl Albrecht fear, out of which almost all of our other fears are manufactured. And we can see that coronavirus attacks directly to mankind's major basic fear, which is the fear of extinction. The notion of dying, the notion of having other people close to us die, it's a primal fear, and is our one of our major basic fears. So how did I go about to trying to put numbers into fear? I took the U.S. population and I left out anybody below 20 years old, and then I divided it in four groups. Uh, and here are the numbers of population that each group entails. And then I defined five categories of scared as fearless, audacious, regular, cautious, and scared. And then for each age range group, I assign a percentage of the five categories of scared, which result in the matrix presented below. So the fearless are higher in the younger people and less in the older people, and similarly, the audacious, the regular, the cautious are higher in the big higher age group range, and so the scares. Then, for each of the five categories of scared, I assume the time it will take for the fear to subside. So, for example, the fearless were never scared in the first place, so that will be our starting point. The audacious will take 6 months to go back to normal, regular 12 months, cautious 18, and scared 24 months. And so, putting all this information together, the fear factor matrix is built as fearless of the total population is 13.37%, audacious 17%, etc. And so this is our starting point because they were never scared, as I said before. And then the audacious, I assume a linear behavior, and they will be recovering the first 6 months at the rate of 2.83% per month, and so on and so forth. With this, I prepared this. I obtained this graph, which, as I said, this is the starting point of the fearless, and then every month we recover a bit, and it has sort of an S-shaped curve. The economic recovery path, and here I want to make a parenthesis. And having 4 kids, I have seen Mary Poppins like 16 times, so I remember this tune from the original movie Mary Poppins. Winds in the east, mist coming in, like something is brewing and about to begin. Can't put me finger on what lies in store, but I feel what's to happen, all happened before. I experienced firsthand the subprime recession from 2008 and 2009. And the next slide, I will present some analysis I did back then and comment on the implication it might have in this crisis and the similarities and differences. So, the subprime real estate driven recession had an impact overall in real estate price variation of 20%, and it took 48 months to make a full recovery, or price recovery or comeback. New York was hit by 22%, and it took 36 months to recovery. Los Angeles, 33%, and took 48 months to recover. San Francisco, almost 30% and 36 months to recover. Miami, Fort Lauderdale, 52% and 54 months to recover. Boston metropolitan area, minus 17% and 40 months to recover. And the place where I was based was Fort Myers, so I followed this very closely. I was hit 56%, and Naples next to it 50%, and they all took 60 months, if not more, to recover. So this is what it looked like, and you can see that it was like a U, like in U shape or bathtub curve, and you see that, and you can also see that some of the bigger cities were hit hard, but they also tend to recover or start recovering faster than smaller cities. So this was the curve for Fort Myers, and as I said, I was there when this drop came about, and prices simply plummeted overnight to like 50% of where they were, and it took like 60 months to recover. So, from that observation, one could draw two conclusions. Um, the real estate recession will last 48 months, and the battleship metro urban conurbations tend to fall deeper but bounce back faster than the rest of the urban and suburban cities. Although these are reasonable conclusions, I think this time around the economy as a whole will take more like 35 to 36 months to recover, while the real estate recession, if such thing even exists, will be a mixed bag. I think on average it will be more like 36 months, but some products will take longer to recover, while others will be either impacted very little or will recover faster. So I prepared this economic recovery matrix where um, per month, the first 4 months is 0.5%, then 0.75, and 1%, etc. And so we are accumulating economic recovery, and in 48 months, it should be over. And with that, I did this curve again, sort of a flat S-shaped curve with the past to pre-corona status. Then I went to the market correction, and the market correction, I said hotels will take 48 months to recover, rest of art, entertainment, and office and retail 36 months, residential 24 months, and industrial 18 months. And and then again with the urban suburban differentiation. And so crossing this information against the months to recovery, I did this matrix for market recovery for hotels, for rest of art and office retail, for residential real estate, for industrial real estate. And the cosmopolitan urban and urban suburban correction is again quarterly recovered and in 36 months for urban and suburban. And of course, urban falls deeper, and then it starts to recover faster, and suburban locations are have a more consistent and average recovery. Then, with all these four factors or variables, if you want, I did some runs. First, the unweighted base is that 25% each, so each has the same weight. And then I run all, it's all fear, it's all economic recovery, it's all market correction, it's all location correction. And then I did what I like to call the American scenario, where economy tends to be very big in the impact. So I put 70% to economic recovery and 10% to each of the factors. With that in mind, I did this runs of the model unweighted, and you can see the different paths from urban hotels to um, to sorry, what is that? To restaurant and entertainment and offices, and then also for industrial and residential. And so we go from urban residential to suburban industrial. And as you see, because this is all relative to pre-corona, they all tend to uh, flatten out and to reach their equilibrium point at some point in time. Then scenario one with all is fear, of course, because all is fear and the fear factor was is supposed to subdue in 24 months, everything converts to 24 months. If we do the fear factor for residential and industrial, again, it all converges to 24 months. Then if we do economic recovery, everything goes further to 48 months. Again, to 48 months. Then market correction, uh, depending on the asset, it goes to 36 months or to 48 months. And market correction again for industrial and residential. In one case, it converges in 18 months, in the next case, in 24 months. And finally, for the scenario with location correction, of course, things go again to 36 months. And again for residential and industrial. So now I did some weighted models. And then I said, okay, let's say uh, I'm wrong and it's not 48 months, so it's 3 years instead of 4 years it takes to recover. Well, then in one case, in this case, it's hotel projected recovery path. In one case, it becomes everything is over in 36 months. In the next case, 48 months, and the recovery curves are different, and one looks more like S shape, the other looks a bit more linear. The same for retail, the same for office, the same for residential, and the same for the industrial products. Some conclusions open to discussion. Recovery times to 80 and 90% pre-corona relative values for 36 and 48 months of economic recovery. To recover 80% of the value in 36 months, in the 36-month scenario, it will take like on average 24, 25 months. For the 48-month scenario, it will take between 25 and 30. Again, for 90% value, it goes a bit higher to like 30 months and 32, 33 months. And of course, for full recovery, 36 and 48. Uh, this projection might have some value in determining investment or divestment decisions and opportunities because you can, if you think this analysis is correct, you can time your investment or divestment decision and opportunity. I did a small cash flow scenario where with unlevered cash flow of buying an asset today at the cap of 5% with the discount, the current discount of 20%, and then selling it in 24 months at an 80% value, gives an IRR unlevered of 14% and 25% levered. Of course, it's not easy, but it's feasible. And I can tell you from experience of the development I have done in the United States that right there is a premium of 5% on your annual IRR, which is pretty significant. And so there are opportunities out there, and as I say, maybe they are not easy to find, but they're feasible. I think there will be people stressed with asset stress that will have to try to make some cash to have some liquidity. Some changes are here to stay and will shape the future of the real estate products of the future. All real estate assets are worth less today than they were worth in January or December last year. Recovery will not be fast and will impact different real estate products in different depths and time frames. I foresee a lot of reconversion, and I envision the birth of a new type of real estate asset. So this is the end of this webinar. I hope you find the information useful. You can download it in the file section, and I hope you, if you have any question, please feel free to send me an email or and just formulate your question. I thank you for your time and hope you like it. Thanks again, and hope to see you soon in another ROC webinar.